South Korea's Kospi dropped 8% in a single morning. Trading stopped, not because of a glitch, but by design. These automatic halts touch every market on Earth. So here's the question: do they actually stop a crash, or do they just delay one? Chip stocks fell hard across the United States and Asia as jitters around artificial intelligence rattled investors. South Korea's Kospi index slid 8% in a single morning session. The drop was sharp enough to trigger a temporary pause in trading, a mechanism built into the exchange for exactly this kind of moment. It wasn't a malfunction. It was the system working as intended. That raises the question that sits underneath every market sell-off. When the floor drops out, what actually catches it? The answer lives in a mechanism most investors never think about, until the day they desperately need it. Every major stock exchange in the world has a version of the same idea. Push prices down fast enough and the market pauses. Traders call these circuit breakers. The name comes from electrical engineering, the switch in your fuse box that cuts power before a surge burns the house down. In markets, the surge is panic, and panic, left unchecked, feeds itself. Here's how it starts. A large fund sells a big block of shares. Prices dip. Algorithms read the dip as a signal to sell more. Other funds see the movement and follow. Each sale pushes prices lower, which triggers more sales. Within minutes, what began as a considered decision becomes a stampede. Circuit breakers exist to interrupt that loop. They force a pause, seconds, minutes, or the rest of the day, depending on the exchange and the size of the move. In that pause, human beings get a chance to think. Orders pile up instead of executing blindly. Information spreads. The stampede loses its momentum. That's the theory, anyway. Whether it works in practice is a more complicated story, and it's exactly where this mechanism gets interesting. Think about a rumor spreading through a crowded theater. Someone near the back shouts that there's smoke. A few people stand up. Others see them moving and assume the worst. Within 30 seconds, everyone is running, not because they smelled smoke, but because they saw other people running. The exits jam. People get hurt. Not because of a fire, because of the information cascade. A market sell-off works the same way. The trigger might be real, a genuine change in the outlook for a sector, like concerns about the future of AI spending hitting chip companies hard. Or the trigger might be a rumor, a misread headline, a single large order that looks scarier than it is. It almost doesn't matter. Once enough people start running for the exit, the running itself becomes the news. Circuit breakers are the equivalent of someone cutting the lights and locking the theater doors for 5 minutes. Not to trap anyone, to stop the cascade before it becomes irreversible. Exchanges set their thresholds carefully. A small dip, 2 or 3%, doesn't trigger a halt. Markets move that much on a slow Tuesday. The halt kicks in when the move is large enough and fast enough to suggest that the cascade, not fundamentals, is driving prices. On the day the Kospi fell 8% in a morning, that threshold was crossed. The doors locked. Here's what happens inside that pause. Traders can't execute new market orders, but they can think. Institutions reassess their positions. Risk desks call portfolio managers. In some cases, central banks and regulators check in with exchange operators. The pause doesn't change the underlying news, but it gives the market a chance to separate the signal from the noise. When trading resumes, the mood is often different. Not always calmer, but more deliberate. And deliberate selling, even heavy selling, is less dangerous than a blind stampede. The mechanism isn't magic. It's a speed bump, not a wall. But speed bumps save lives. And in markets, they can save portfolios too. This is where it stops being abstract and starts hitting your actual life. Pension funds hold equities. So do the retirement accounts of ordinary workers who never pick a single stock. When a market drops 8% in a morning without a circuit breaker to slow it, the losses can compound faster than anyone can react. By the time a small investor even hears about it, the damage is done. Circuit breakers give institutional managers time to act before individual investors are wiped out by a cascade they had no part in starting. There's a supply chain effect too. South Korea is home to some of the world's largest chip manufacturers. Chips go into cars, appliances, phones, data centers, everything. Sharp volatility in the stocks of those manufacturers can affect their cost of capital, their ability to raise funds, and their investment plans. That doesn't mean a single morning's sell-off rewires global supply. But sustained volatility in that sector tends to slow investment decisions, and slower investment in chips eventually shows up in the products on a shelf, in the wait time for a new car, in the data center capacity that every streaming service and cloud platform depends on. The circuit breaker doesn't prevent any of that. What it does is prevent a bad morning from becoming an irreversible afternoon. It keeps the damage in the realm of the recoverable. That distinction, recoverable versus irreversible, is everything in a market crisis. So back to the question from the start. Do circuit breakers actually stop a crash, or do they just delay one? Here's the honest answer. They don't stop anything that is fundamentally true. If the underlying reason for selling is real, a genuine shift in the economics of a sector, a structural change in earnings expectations, then the price will find its new level eventually. The pause doesn't alter that destination. What circuit breakers do is change the journey. They prevent a crash driven by mechanics rather than reality. They stop the theater stampede that happens because of running, not smoke. In the case of a sector rattled by shifting sentiment around a new technology, where the future is genuinely uncertain and valuations are partly built on expectations rather than current earnings, panic can move prices far beyond what the fundamentals justify. A pause forces the market to ask, is this selling real or is it reflexive? Sometimes the answer is both, and that's fine. A market that prices in real uncertainty is doing its job. A market that sells into a void of pure momentum is not. The Kospi halt is one example of a mechanism that now exists on every serious exchange in the world. It was built after the crashes that didn't have it, after the days when cascades ran uninterrupted and wiped out years of value in hours. It isn't perfect. No mechanism is. But it represents something important. The recognition that markets are made of human beings. Human beings panic, and panic is not the same as information. The circuit breaker is the market's way of giving itself permission to breathe. And sometimes, breathing is the most valuable thing a financial system can do. If this changed how you think about market sell-offs, subscribe to Investors Club Global. We explain the mechanisms behind the headlines every week.